In case you've been living under a rock, the U.S. debt is climbing like crazy. Fed Chair Jerome Powell and other policymakers have indicated the surge in long-term Treasury yields may reduce the case for continuing to hike the central bank's benchmark interest rate. The FOMC announces their rate decision Wednesday of this week, and now everyone is expecting a pause. This sounds great on the surface, but it is a bit weird when we add back their projection for GDP. For context, the Fed has been saying that they expect below-trend growth in GDP for some time in order to reach their goal of 2% inflation. Well, the preliminary third quarter GDP could wreck that plan because it was notably higher than expected. It came in at 4.9% versus estimates of 4.1%, and the price index shot up to 3.5% versus estimates of 2.5%. That's not below trend at all. That's not even neutral. It's higher, and proportionally, it's higher by a lot. And that is the exact opposite of what the Fed needs to see. A new study of 1,163 adults between October 5th and 9th reveals that 2 in 3 Americans said their household expenses are a lot higher than a year ago, but just 1 in 4 reported rising income in the same time period. The poll found that 8 in 10 of those who responded reported higher overall debt, with half reporting credit card debt, 4 in 10 saddled with car loans, and 1 in 4 with healthcare-related debt. Only 15% reported a rise in household savings over the past 12 months, 18% feel confident about their retirement savings, while 3 in 10 say they've delayed on a big purchase due to higher interest rates. And 1 in 4 report student debt. This is all packed into the affordability conversation we keep having when it comes to mortgage and real estate. Aspiring home buyers are saddled with increasing costs to service debts and higher debt balances spread across more debt accounts, all of which negatively impact their housing affordability. We're going to have to change our spending habits, our saving habits, and buckle down on paying off debt in order to turn up our percentage of home ownership in this country. And guess what? Inflation is still in the positive, not yet turning in the right direction fast enough. The September PCE, personal consumption expenditures, came in at 0.4%, but was expected to be 0.3%. Year over year, overall PCE, thought to be 3.4%, came in exactly that, 3.4%. So that's at least fine for there. Markets were expecting inflation to stabilize, but data suggests it's slowed, but very little. And this puts the Fed in a very precarious situation coming into this week. They have to tread very carefully at their Fed press conference coming up on Wednesday. We are all expecting them to pause, even though a rate hike now or in December is what they previously loaded in their chamber. The comments, justification, and context Jerome Powell provides should tell us if this is really it, if they should have hiked in September, or if they will have to hike in December. The spotlight is directly on the Fed this Wednesday, and it really matters. So with that, let's take a quick look at what's coming up in the markets this week. Tuesday, employment cost index, home price index month over month, and consumer confidence come out. Wednesday, ADP non-farm employment change, ISM manufacturing PMI, and JOLTS job openings come out. But the most important part of the day will be the federal funds rate decision, Jerome Powell's prepared statements, and the press conference to follow. The latest sentiment is that they're likely to pause because of the meteoric rise of the 10-year yield, which has other future-looking impacts still yet to be made. So, does that make it the savior, or will it be the 2024 thing that we have to contend with? Then on Thursday, we get unemployment claims, and Friday, we see average hourly earnings month over month, non-farm payroll employment change, unemployment rate, and ISM services PMI. And that's it for this week. Remember to like this video, subscribe to the channel, and turn on notifications so you catch every episode.